The stock market continues to react to the Fed rate hike. Alan Knuckman, chief market strategist for St. Paul Research, is standing by. Alan, what's your take on the market?
Hello, Angie. A disappointing dive down in stocks after 10 days of sideways and that big bounce from the bottom. We couldn't follow through. But let's remember, it was only a few sessions ago we were at 4,200 in the S&P, about 10% higher.
As a pro trader, what are your trading strategies?
All right, let's talk a strategy session today. Well, you want to buy when things look bad, if you're bullish, and sell into strength. And that's what we've done in the last couple of weeks. So as a reminder to everybody and to myself, we use that recent strength to take profits. We had 250% gains last week and 250% gains the week before. So now we'll reset with some new buys for the future.
This week, you are focused on a trade in a company that owns and operates pipelines.
All right, today's trade trigger is in Kinder Morgan. So again, the theme has been for the last few weeks and months is oil's well. That sector continues to show strength. We've seen a little bit of a pullback here, but crude oil hit nearly at 125 here this week. Now, KMI is down 10% from its recent top on the June the 8th, just a few days ago, but it's still up 100% from its COVID lows. Now, it's trading about 18. The high in it in 2015 was 45. So there's a lot of upside potential here. It's a stock that's been trading between 15 and 20 for the year. So 1750 is an important midpoint support to lean on. I'm looking at the January, 7 months at time, $17 call just below that support point. That's trading for about 2.25, 250 or so. It's in the money. And again, 7 months at time. Now, a breakout of this range from 15 to 20 targets 25. And if the stock gets to 25, this option will be worth 8 points. So it'll be a triple or so in this particular strike price in Kinder Morgan.
Let's get your trading day takeaways, starting with the Fed, because it's likely we are going to see more Fed hikes.
All right, today's trading takeaways. Number one, 99%. Not 100%, but 99%. The market shifted to almost a sure thing of a 0.75% hike in rates. Now that brings us to a whopping 1.75%. Number two, destination known, question mark. Now there's a show, destination unknown. Now this is destination almost known. The fact is everybody's been playing kind of a parlor game as far as how much the Fed's going to raise rates, in June, in September, in December, and so forth. And it's not as important to me how much they do each time is what the end result. So I talk about the destination. And if you look at the destination, the markets are telling us that the end of 2023 rates are going to top out, short-term rates that the Fed controls are going to top out at 4%. Then after that, they drift back down to 3.5% from 2024 to 2028. So there's some positives there. The end is in sight. And that's still historically super, super low. Number three, gaps above. So this S&P slam down to new swing lows has left some gaps up above. So it'll be interesting to see, again, let's see how the markets, not how they act, but more importantly, how they react and see if they can go back up and fill in that gap at 4,000 and then where we go from there.
Have a wonderful rest of your trading week, Alan.
Thank you.
Go to businessfirstam.com for where to see our show on TV.